Good morning, everybody. It's 10 o'clock, so we're going to go ahead and get started. Thanks for being on our webinar. And as you all know, we've got a 1-hour session planned and a lot of information, and we're going to move through it pretty quickly. I think the important thing is just to kind of pay attention to certain things that might be applicable to you, and then just be aware of them. And there's a lot of information out there to dig into the details that we're going to make you aware of if you're not aware of that already. And hopefully this will be beneficial to you. And I have a couple of other presenters with me. So I have Ron Marshall. He's a tax partner in our Macon office, and he's a leader in our tax practice, and he's going to go over tax provisions related to the CARES Act. And then I have Ryan Inlow with me, who is a partner in our Albany office. And Ryan is going to cover a very important topic that you might not have heard as much about, and it's the employee retention credit. And it does relate directly to PPP round 2. So you want to pay particular attention to Ryan. And for some people, it might even be more important than this new round 2 of funding that's available through PPP. And then I'll be covering primarily the second draw of PPP.
Jeff, I'm just going to interrupt real fast. I was going to say, if people have questions, use the chat box. We'll try to monitor that and kind of ask questions as we go, but we may save some of them till the end. We will have a Q&A at the end, but do put your questions in the chat box.
And actually I had a client email me this morning asking this, but this session is recorded and it's going to be available on the Malden and Jenkins website. So feel free to access it there if you have a need for that. And here's the contact information for Ryan, Ron, and myself if you want to email or call us with any questions. Okay, so we'll get started just by talking about the second draw loans that are available now. So one concept that I try to point out that might not be completely obvious, you've got first draw PPP loans that were available and ended in August of last year, and now we've got second draw. So with these rules, the first draw rule still apply to some people if you have not taken a previous loan before. So keep that in mind. If you have not taken a first draw, there's more money available now through this funding. And this all resulted from the Consolidated Appropriations Act. And there's a stimulus package that was part of that was about $900 billion. And just to give you a rough idea that you can see on the screen, the amount that was allocated to the second draw loans was $284 billion. And the first time around, with the first draw original PPP, there was $669 billion that was allocated. So we've got a smaller amount that's available this time, but the qualifications are different. So not everybody's going to qualify as easily as you might have qualified the first time. And so we're thinking that this round, and this is just a matter of opinion, so we'll have to see, the use of these funds might go a little bit slower because of these new qualifications that are in place, but we're still encouraging people to apply, as soon as they can. And as you can see on the screen, the last date that you can apply is March 31st. I've already read where there's some anticipation that if this money runs out, there could be additional funding. And if you remember, the first time we had PPP funds, that did occur. The money actually ran out pretty fast on the first allocation, and then additional monies were made available. And then they actually did not utilize all of the funds that eventually were made available, with the first time of PPP. So some of the changes here: maximum loan size is $2 million. With PPP 1, it was $10 million. And there's a lot of similarities now with the second draw compared to the first draw. And one of the similarities is you can receive a loan up to 2.5 times your average monthly payroll cost, and there's still that $100,000 cap per employee. And if you've got the 72 starting NAICS code, there's a difference. You can receive up to 3.5 times your average monthly payroll cost. And that average monthly payroll cost is 1 year prior to applying for the loan. So for you all, most of you, that's going to be 2020 that you're going to be using to compute your average monthly payroll cost. And for Schedule C borrowers, this hasn't changed. The loan size is 2.5 times your net profit. So if you look at your Schedule C for 2019, you probably don't have it yet for 2020, and multiply your bottom line net income on your Schedule C by 2.5 times. That's the amount that you'd be eligible for. And then there's certain other limits too, but there's really no change there. Loans will be forgiven if certain qualifications are met. We're going to talk about that in more detail in a minute, but the big deal is that you spend just like the first time around, that you spend the money on qualified expenses, which is primarily payroll. Payroll has to be 60% of your total expenditures, and then rent, utilities, and then there's other expenditures that we're going to cover that are qualifying now. One thing that is nice that they have addressed with the second draw loan is your covered period can be anywhere from 8 to 24 weeks. It doesn't have to be 8, it doesn't have to be 24, it can be 10, it can be 15, it can be something in the middle, and that's going to be your cutoff. And we had interpreted that same thing ourselves, helping our clients with the last time around with these PPP funds, but now they've made it clear that you can have a time that's in between the 8 and 24 weeks. And I don't think I've got this on my screen, but a little pointer, if you haven't discovered this already the first time around, if you have an FTE problem, or if you've had a reduction in compensation to where you might be penalized on your forgiveness and not receive all of your forgiveness, one way of avoiding that problem is to utilize, in this case, the full 24 weeks, possibly, if that's what's needed. And the more you spend in this covered period, it reduces the negative effects of a reduction in your full-time equivalents or a reduction in compensation if you have that situation. Another big deal now, and this is really nice, previously they were reducing your forgiveness, SBA was, by any EIDL $10,000 advance that you might have received, and that has been removed, so that's no longer the case. And just, this is not a presentation about EIDL, but I was just reading yesterday that the portal through SBA for EIDL is going to be open very soon. I think they're expecting it to be open in like the next couple of days, and you'll be able to once again apply for an EIDL advance, which is a forgivable advance that you don't have to repay, and then an EIDL loan. So it's a disaster loan through SBA, and you have to qualify to receive that loan.
Hey, Jeff, if your loan has already been forgiven and you were charged for that EIDL, have you seen much guidance out there yet on how they're going to handle that situation?
Yeah, and they're actually, I think they're getting some guidance out to bankers on how they're going to resolve that. And I know that going forward, of course, they're not going to be making that happen, but the bankers are being made aware of guidance on how they're going to settle that up. And I was on a call last week with a banker, and he was kind of joking about it in regard to how they weren't sure at that point how it was going to work, but there is going to be plans to make that happen. So, so once again, there's some common requirements here. So previously, so under the original program, it was 500 employees or less, and then you had this. You had to pay attention if you had the 72 NEIC code. It was 501c3 organizations, sole proprietors, independent contractors, self-employed individuals. So all of these same groups are still qualified under this new program. And a big change is 501c6s now are included in this program. And one thing to remember, and I kind of started off talking about this, if you're 501c6, because you weren't eligible before, when you apply for this now, you're applying as a first draw recipient, not a second draw recipient. So that means you don't have some of these other eligibility criteria to pay attention to that we're talking about here on this screen. So it's going to be easier for you to receive your funds versus somebody who previously qualified and used PPP funds before. So one of the things in this new law says that you had to use your prior PPP funds in full prior to the disbursement date that you receive your second draw loan. So I thought it was interesting that they're getting kind of picky there, but it looks like you could actually apply for your second loan, and as long as you spend the money on the first loan prior to when you receive the second draw, which I think the timing of all this, there's not going to be many people who have got a problem with this. They've reduced it from 500 to 300 for the second draw. It's still 500 for the first draw. And there's a new requirement now that quarterly gross receipts are reduced, or you have to do a calculation to qualify for this, where you're comparing your quarters for 2020, and then for any one quarter, you had to have a 25% reduction in revenue compared to 2019. And another way to look at it, which is more of a simplified approach, if this works for you, if you had 2020 gross receipts that were 25% less than 2019 in total, not by quarter, but for the entire calendar year, you would qualify, for this second draw. There's information that says that you can't be primarily engaged in political lobbying activities, and then as far as who qualifies for this, it's basically like on the screen that I showed you before. Everybody except governmental entities, lobbying organizations, and there's some other exclusions for members of Congress who are shareholders in companies, and then if you've got ties to China, there's numerous exclusions, but for the most part, most businesses are qualified to apply for the second round if you're not a government. And then this screen talks about the expenses, and there is a change here. One thing that has not changed is the fact that 60% of your payroll expenditures is still a requirement, for full forgiveness. You have to at least have 60%. It can be more. You could have 100%, but it has to be at least 60%. And then you've got other non-payroll expenses that are covered, which includes mortgage obligations, rent obligations, utility payments, certain operations expenditures, property damage costs, supplier cost, and workers protection expenditures, which is, the things that we put in place in our offices to keep our workplace safe, during this pandemic. So this is a summary screen, but there's more information on this in the guidelines. And the good news is there's an expansion of the covered expenses that are outside of the payroll expenses. For all practical reasons, and Ryan will talk about this, if you're not going to end up using the employee retention credit, a lot of our clients have enough payroll in their covered period where they're not even worrying about all this other cost, and they're just reporting the payroll in order to get full forgiveness. But you do have these others that you can include on your forgiveness application. I had to dig into this a little bit because to me this was not the most clear thing in the beginning, but the FTE and wage reduction calculations are still in effect, and the Act clarifies that they're extending the deadline for restoring your FTEs or your wage reductions to the end of your new covered period for your second draw. So just be aware that if you had a reduction in full-time equivalents last year, after this pandemic hit, or if you've cut wages, you've got to do some math just to see if that potentially will have effect on reducing how much forgiveness you have. But you can cure that and restore your FTEs by the end of your new covered period and not have any penalty. And like I mentioned earlier, you can spend more money than how much you borrowed in your covered period. In particular, that's easy to do with payroll, and that reduces any negative effects of FTE reductions and payroll expense reductions. And I can't say that, and I've helped a lot of clients with their forgiveness applications now. I can't say I've really had any that have done pay cuts, that were more than 25%. Most of the time that we're spending is calculating full-time equivalents to see if there's a reduction there that could cause a reduction in forgiveness. This question is coming up a lot, and so I actually added this screen after we had kind of our first draft of our presentation. And if you read the definition of gross receipts, it covers almost everything that you would typically classify as revenue on your financial statements. And what it does not cover is gains and losses, which that can be significant for some people. And if you're on an accrual basis of accounting, you want to measure gross receipts on an accrual basis of accounting. If internally you're accounting for your business on a cash basis, then that's the method that you're going to use for this calculation. And once again, if you just look at the screen, it includes services, interest, dividends, rent, royalties, fees, commissions, and it does not include sales taxes if you're collecting sales taxes and that you're remitting, on your products. And there's some other exclusions, but it's most everything except for gains and losses. And why we're talking about this, if you recall what we've already talked about on a previous screen, to qualify for this second round of PPP funding, you have to have at least a 25% reduction in revenue in any one quarter in 2020 compared to 2019, or a 25% reduction overall calendar year 2020 versus 2019 in revenue. So this ends up being a really important computation, and this is the main thing that will prevent you or allow you to receive funding under this new program. And another thing that they pointed out, which is good news, revenue excludes PPP forgiveness. So if you're doing the math on this, and in your third quarter, you had PPP forgiveness on your financial statements, or your fourth quarter, you can exclude that for purposes of this calculation. They're not wanting to penalize you because you previously have received forgiveness on PPP funds. Audits, we get these questions a lot, and I put a few things on the screen that I just wanted to point out. Especially if you have received $2 million or more on your first round of funding, or if you're expecting to apply for the maximum of $2 million this time, and you want to take a look at this form 3509 if you're a for-profit and 3510 if you're a nonprofit, and it's a loan necessity questionnaire, and it's information that SBA is gathering in regard to your loan necessity certification that I'm going to point out to you in a second here. And we'll cover that, and that's the main reason why I wanted to point these forms out, because when you're considering loan necessity, these are good forms just to kind of get an idea of how SBA might be looking at it. And they've actually come out and said, since these forms came out, that they're not using these forms to penalize people, and they're gathering information. And at first people were worried that they were taking this information and were going to disallow their forgiveness, and they've kind of backed off of that. But just be aware of those forms, and then make sure that you keep your documentation regarding all of this, so that if you do have an audit, you can show them your payroll reports and document payroll, and you can show them how much you paid for rent, and then provide that information. What's different with this second round of funding is the SBA had 45 days to submit audit plans, which is coming up, and that process will allow us to see how they're thinking about the audit process, which will be more information than what we've had previously. So I think that's a positive. And there's also more congressional oversight in regard to forgiveness review activities. So I think Congress is just wanting more information about how SBA is auditing these loans, and they're probably just wanting to see themselves that everything that's happening in regard to this program is what they intended. But indirectly, it's going to provide us more information in order to just see what they're doing. And just to throw this out there, they can audit any application for forgiveness. And in general, they're saying they're going to audit every application, 2 million or more. And we have actually seen several audits where they audited applications that were under 2 million, and just providing support, like payroll support and things like that. So they probably, once they get the volume, and they'll probably just be sticking to 2 million or more, but we've seen where they, at least in the beginning, had looked at a few that were under that. And they were using IRS agents, which was interesting. SBA didn't have the resources to do the audits, and we're coordinating it, at least at that time, with the IRS. So we're giving away a trade secret, but not really. It's kind of a joke, but everything that we're talking about in regard to this PPP program, the Paycheck Protection Program, if you just go to the SBA website, there is tons of information about this, and everything that you see in any articles, presentations like you're attending now is on the SBA.gov website. So if you simply just Google SBA.gov PPP, it will pull up the homepage website, and then you can select different items that you're trying to dig into more. And there's on the website a first draft borrower application form and a second draw borrower. It says draft, it really should say draw, and then a second draw borrower application form. And if you remember what we were talking about originally, if you have not previously taken a PPP loan, you could be a first draw borrower, and then if you previously have taken a PPP loan, you use the second application form using these new rules that we just talked about, primarily being that revenue qualification where you had to have the decrease in revenue. So what I wanted to do here is I want to actually show you the application. And okay, so if you haven't seen this already, it's very simple, which is nice too. They really have taken some steps to simplify the application, and actually the forgiveness process have taken some really good steps to simplify that too. And you can see here that the first thing they do is they get you to check a box to see that you're a qualified organization. And you can see from all these entities they've listed here, including 501c6s now, that most everybody, unless you're a governmental entity, will be qualified for this second draw. And then if you come down and look at it, they get into the math where this is how much you would qualify for in regard to your loan, where they're taking your average monthly payroll times 2.5, unless your NAIC code is 72, which is entertainment and, restaurants and hotel type entities. And so then you can see here that they're spelling out the fact that the loan can't exceed $2 million, where before it was $10 million. And then they're making sure that you're not going to put down more than 300 employees. And prior, like we talked about before, it was 500 employees. And then they want you to identify what the costs are going to be used for. And, you might end up checking most of these boxes, and they just want to see that you're saying on this form that you're going to use it for covered cost. And then you get down into the revenue calculation, like we talked about, where you're demonstrating for them that you had at least a 25% reduction in revenue for any particular quarter. So they're asking you to identify the 2020 quarter and then the 2019 quarter, which would be the same. So if you're using second quarter of 2020, you would use second quarter of 2019 in their example here. And then they're asking, for the actual numbers for those gross receipts, so they can do the math themselves, to see that you actually had a 25% reduction. One question we've had a lot is in regard to the definition of a quarter, and from what we can tell, it is a calendar quarter. We don't think that you can use a different quarter, based on your particular fiscal year end. And another thing I wanted to point out, you've got some basic questions here, which I think are I don't think we really need to cover. But when you get down into the second page of this, they're also getting you to verify that, yes, you were in operation on February the 15th, 2020, so you qualify for that reason. And then the big one that's on here that you still have to certify is that you had current economic uncertainty that makes this loan request necessary to support the ongoing operations of your business. And we didn't want to get into this too much because this can be very subjective, but we wanted to point it out that this is a criteria where you really would want to evaluate as an organization or as a company or as a sole proprietor, that you still have current economic uncertainty so that you can sign off on this certification where you feel like it's necessary for you to receive these monies to support your your operations. And they're getting you to once again say that you had, yes, I had a reduction in gross receipts. They're getting you to verify that if I had a first draw, I spent the money and it's not still unspent in order for me to qualify for the second draw. They're getting you to verify that, yes, you're going to use these costs like we've asked you to use them, to cover these different areas that we're allowing you to use. And they're also getting you to sign off on the fact that you have documentation of these costs, so that they can verify that they're proper cost. This seems like an obvious question, but the first time around, we had clients that were applying for, not intentionally, but they were worried they weren't going to get the money, and they applied multiple times for the first draw request, and ended up having 2 loans, which became a problem, and then had to cancel one so that they didn't have 2 loans. You're not allowed to have 2 loans, you can only have one. And then if you're a shuttered venue operator and you apply for this new grant funds, it's available through the shuttered venue grant. It's a $15 billion program that's going to be administered through SBA. You're not allowed to receive these PPP funds. And if you're not aware of this already, if you are a entertainment venue, like a theater, somebody like that, SBA this afternoon is having a webcast that you have to sign up for. It's on their website, where they're going to cover the particulars of this grant program. And there's a lot of information out there already. And then you might be entertained by this one here. The president, they don't want the president, the vice president, or head of an executive department or member of Congress to be having a controlling interest in any company that's applying for these funds. So just some things to point out, here on the application themselves. And once again, this is if you do your math on which you should be doing this now, on your gross receipts and you qualify, this application will not take long at all to complete. All right, I'm gonna go back to where we were. Okay, I wanted to include this just so you all know that this information is available through these interim final rules, and you can Google it and find a lot of details that goes over particulars of what we're talking about here. If you have a particular situation and we haven't talked about it, there's a lot of information. I think there's 82 pages in one of the rules that describes the requirements of these programs. And this is a big deal. When can you apply? So small lenders, and they define small lenders as having 1 billion or less in total assets. Those portals are going to be open tomorrow. And then, so there's probably not a lot of banks that are in that category of being classified as a small lender. And then all lenders, the portal is going to be open on January the 19th, which is Tuesday. So banks should, at least the portals are going to be ready. And then, banks might take longer, depending on where they stand and having their application technology updated for the second round. But just what you should do is fill out that form I just showed you, because it's, it won't take you very long if you've got the numbers, and just be ready so that when your bank is ready, you can apply. Tax deductibility, this is a big deal if you haven't heard about this already. Prior to this act, the IRS was saying that PPP expenses were not deductible, which in effect ended up making the forgiveness amount that you would have received taxable indirectly. And they have now clarified that, and they're specifically saying PPP expenses are fully deductible and loan forgiveness is exempt from taxation. And they've also clarified that it does not reduce your basis in your company, which is probably a little bit more technical than what we would want to get into here. But the big deal is there's no tax consequence to this, and that makes a lot of sense. So it was good just to see that come out and be part of this act. And lastly, I've got a comment on here. If you received $150,000 or less on your first round of PPP funding, and then this will apply too for the second round, they've got a simplified form that's coming out. And once again, I think has to come out today. And it's going to be really basic, where you describe the number of employees that you're able to retain as a result of the loan, an estimate of how much was spent on payroll costs, and then the total loan amount. And then you submit that, and it's going to be a very streamlined forgiveness process, for loans of 150,000 and under. Okay, so now we're going to turn it over to Ryan to talk about the employee retention credit.
Okay, hopefully that screen is up. As Jeff mentioned earlier, the employee retention credit is not necessarily a new concept. It was actually included in the CARES Act, but we didn't get 500 folks on this webinar to hear about the employee retention credit. Everybody's here to think about PPP, and there's really three reasons for that. I would guess that you got together with your team back in the spring and concluded pretty quickly that PPP was the way to go. And the reason for that is mainly the ERC is the acronym I'm going to use. It was a little bit harder to qualify for the ERC versus the PPP. It was not. It did not provide near the stimulus that the PPP could potentially provide. And probably the most important thing is that the two programs were mutually exclusive under the original CARES Act. So that's the reason why PPP is probably one of the more popular acronyms in 2020, and no one's heard of the ERC yet. But that's going to change with the new Consolidated Appropriations Act, the CAA, that was passed at the end of the year. Those two programs, now you can be eligible to participate in both. The interesting thing is that it allows us to actually go backwards and participate back in 2020 when you didn't think you originally could. One caveat there is you really can't use the same wages that you use under the PPP for forgiveness, but we're going to talk about that more in a sec. And I said they made it easier to qualify, which we're going to peel back those layers as well and talk about that. And it's now more lucrative, and I'll walk you through this calculation in a second, but we think it could be worth as much as $19,000 per employee. So kind of a big deal that the CAA now made that program eligible in conjunction with the PPP. So if we just kind of go back and think about what the original ERC was and how this credit works, it's basically a refundable federal payroll tax credit. It's not something on your own individual tax return. It's not or your corporate return. It's not a direct inflow. It is a payroll tax credit. And it's, if you think about it, it was designed to encourage businesses to retain their full-time employees, just like the PPP was. It works the same way. The point of the stimulus is to keep everyone's workforce intact, so that when we come out of this pandemic on the backside, everybody can be up and running quickly, and to keep folks off the unemployment rolls. So just another mechanism to do that. It's claimed, the ERC is claimed on a quarterly 941, which you're all familiar with. There's actually a specific line item on the 941 that asks how much your employee retention credit is, and that will reduce the amount that you either have to pay in or will give you some sort of a refund, which we'll talk more about later. One of the more interesting facts of this is, and something that not to lose sight of, is that the number of employees is not as important for this as it is for the PPP. The PPP is administered through the SBA, the Small Business Administration, which, the definition of small business is under 500 employees. Well, this program has nothing to do with the SBA. It is an IRS driven and monitored stimulus package. And so the number of employees don't matter. So you could have larger companies out there that can participate in this that could not participate in the PPP. And in a nutshell, under the CARES Act, you could get up to 50% of $10,000 of qualified wages per employee as a tax credit. My simple mind can calculate that as $5,000 per full-time employee for 2020. Now that's for the whole year. You're limited to $10,000 of qualified wages for the year, and that the CARES Act was effective for the ERC for qualified wages between March 12th and the end of the year, December 31st. Well, the CAA, the Consolidated Appropriations Act, came into play, and they sweetened the deal and gave us 70% of up to $10,000 of qualified wages for each quarter. So you can do the math. Now that's $7,000 per quarter per employee just in the 2 quarters of 2021. So much more stimulus provided there, much more beneficial, and I hope we can all find a way to be qualified under this, which we're going to talk about now. Importantly, that is just for wages. The 70% of the qualified wages is just for wages paid from January 1st to July 1 or June 30. So right now that is set to expire after the second quarter of 2021. We may get more relief, we may not. We'll just have to kind of wait and see there. So we mentioned, it's a little bit more difficult to apply there. With the PPP, there was really, in the original PPP, there was no requirement for a reduction of revenue. You really just had to meet that economic uncertainty certification. Wasn't, the rest was just math, and you could qualify, which is why everybody was able to participate. But the ERC has some more stringent requirements. So there's 2 ways to enter the ERC program or enter eligibility. The first way is to be fully or partially suspended from a government order during COVID or due to COVID that limited your ability to transact business. You may be thinking, well, gosh, everybody has that, and that's true. A lot of folks will meet that. I would tell you that I think the better way to qualify would be the second bullet point here, which is to experience a significant decline in gross receipts during any quarter. We're going to fully define that and go through it. But the reason I think that it's a little bit better, the fully or partially suspended criteria, and this is an either or. The fully or partially suspended criteria is only for the period of time in which you are affected by this. So it could be a shorter period of time. The significant decline in gross receipts, that's a quarter by quarter thing, so you could potentially be eligible for this program for a longer period of time. So how do we, we're going to do a little bit more, but just a quick change here. The original CARES Act, you had to show gross receipts declined by more than 50% in any one calendar quarter of 2020 compared to the same calendar quarter of 2019, which was a pretty big hurdle, and a lot of folks couldn't jump over that. For 2021, that they've given us some relief, and that percentage decrease is now 20% for any calendar quarter in 2021 compared to the same calendar quarter. And get this, it's still 2019, so you don't get to compare to 2020. Which probably wouldn't help anyway, but they're trying to compare pre versus post-pandemic revenue numbers. So if we think about what that means, a significant decline in gross receipts, the IRS actually, as I mentioned earlier, this is all IRS regs and not SBA rules and IFRs and things like that. But they kind of define an entry point into eligibility and an exit point when you leave eligibility from a gross receipt standpoint. And it begins in the first quarter of 2020, in which gross receipts were more than 50% down over the same quarter of 2019. Now, if we think about the first quarter of 2020, our world began to get turned upside down into February, early March. Probably mid-March is when things kind of came to a screeching stop. And so it's probably unlikely that you felt as big of an impact in the first quarter of 2020. But the second quarter of 2020 was, a crazy quarter that I don't think anybody will ever forget. And it's pretty likely that you experienced more than a 50% decline compared to the second quarter of 2019. So highly encourage you to kind of take a look at that. The interesting thing here is so that's how you enter eligibility. You exit eligibility in the quarter following the quarter, and I've got that underlined because we're going to talk about it in a sec, in which gross receipts were more than 80% of the same quarter of 2019. So you enter with a 50% decline, you exit when you rebound to get to 20% down. But the quarter over quarter thing is interesting because the IRS is in effect giving us 2 full quarters, because you don't exit until the quarter after you recover to a more than 20% decrease. So let's say for the second quarter of 2020, your world stopped, your business stopped, everybody went home, you did nothing. It's easy to show that 50% decline over the same quarter of 2019. But by the third quarter, everyone was back working. You were in a spot that wasn't hard hit by the virus, didn't have any government orders that kept you from conducting your business. Your customers were in good shape, and you're back, right? You're maybe only 10% down in the third quarter compared to 2019. Well, in that scenario, you still get the third quarter to be eligible to calculate this 50% of wages. So you're still there, and you don't exit until the fourth quarter. So really kind of a good way to stay in for 2 quarters. I'd venture to say that the other way to get eligibility of being fully or partially shut down, most folks won't meet that for a full 2 quarters, but we'll get into that in a second. Just to reiterate, the required decline of gross receipts, the new act here, the CAA, the Consolidated Appropriations Act, changed that from 20%, changed it to 20% from 50%. But keep in mind, that is only looking forward to 2021. But also, you're still comparing to that same quarter in 2019. One little probably interesting facet of this new bill that's kind of hard to understand, and it took everyone a little while to figure out what they're doing. But there's now an election to use the immediately preceding quarter to evaluate your significant decline in gross receipts. That doesn't really matter much, I don't think, in 2020. But where that could come into play is for the first quarter of 2021, you are able to look at the fourth quarter, of 2020 compared to the fourth quarter of 2019 in order to get in the first quarter of 2021. The important part of that is you get to use the 20% as opposed to the 50%. So granted, it's a 20% decline for Q1 and Q2 of 2021, the 50% decline in all of 2020. But if you're using the safe harbor for the immediately preceding quarter, and your preceding quarter is for Q1 of 2021, you get to look at Q4 20 compared to Q4 19 at a 20% decline. If you meet that, then you're probably eligible, and you're eligible for the first 2 quarters of 2021. So the other way to be qualified for this program is to be fully or partially suspended by a government order. And this is going to be a facts and circumstances type test. There's some judgment involved. It's going to each business is going to have to really look at their own activities and kind of make their own judgments. But important to note here, it's either you're forced to fully cease operations, or it could be that you were impacted with some but not all of your operations. The IRS just says it has to be more than a nominal portion. Interesting thing here is if you're an essential business, it's likely that you're not going to qualify, because if you're an essential business, you're still able to operate during this period of time. But the IRS does say, well, if you were an essential business and your suppliers were impacted by a government order and they were not able to provide you any of your inventory, supplies, whatever, you may qualify in that regard. But again, it's going to be limited to the period of time that the government mandate applies. Same thing with customers, although I think that's a little bit more of a stretch. But if you have a very targeted small customer base and you can easily point out to the impact of them on a government mandate, then you may be in the same spot. I would highly encourage you to look at the IRS website, irs.gov. They have some frequently asked questions on this ERC, and it's really well written. It's some plain English that's easy to understand, and they give some real life examples of when you've been forced to cease because of a government order. And, one of the examples that they give is a software company that has to close their offices and sends everyone home for 2 months, but all of their employees are able to work remotely or telework, and their operations, for the most part, were able to continue. They said that would not qualify because that was not more than a nominal portion of your business to be shut down. So, again, if you think you're in that category, most of you are probably in the Southeast. We didn't have quite the same lockdowns as in other parts of the country that were harder hit. So this may be a little bit higher hurdle to jump over and longer and shorter duration. I won't spend a lot of time with this so that we can make sure we get everything in, but this government orders under this definition, it does include an order from a city's mayor stating that all non-essential businesses must close for a specified period of time. In the example of an order mandating a workplace closure for cleaning and disinfecting, that would qualify. But again, let's say that lasts 5 days. That's a period of time that you're eligible, not a whole quarter. So another important thing to think about is we do calculate the credits that are based on the qualified wages a little bit differently. The only time the number of employees is important is under the CARES Act during 2020. I shouldn't say it's old because the CARES Act is still effective, but in 2020, if you had more than 100 full-time employees, the wages that qualify for this are only for compensation paid to employees who are not providing a service. So if you're basically having to pay your employees to not work or stay home, that would count, but wages for employees that are working would not count. If you're fewer than 100 full-time employees, then all wages paid to those employees count for this credit, regardless of whether they're providing services or not. The Consolidated Appropriations Act, the CAA, passed at the end of the year, moved that number up to 500. So a lot more beneficial for us there for most of your middle market type entities. And again, it applies to the compensation there listed at the bottom of the screen for 2020, and then for the first 2 quarters of 2021. One thing to note here, if you did furlough employees, and so under a real strict definition of a furlough, you weren't paying them during that period of time. If you left those employees on your healthcare plan and incurred expenses associated paying for their healthcare, those costs would qualify for wages. And so you may not have paid the employees $10,000 per quarter, but maybe you have some expenses associated with healthcare costs, and that would still get you to a credit there. I just covered that. The second bullet point here is probably something to think about from a strategy standpoint. Hopefully you're talking to your M&J team on this. If you haven't already applied for forgiveness on your first PPP loan, or if you were still, obviously just now applying for round 2, but the wages that you use for forgiveness on these PPP loans cannot be used to calculate a credit on for the ERC. And the strategy involved here, I think, Jeff mentioned this early on, originally everyone was moving towards, let's just use payroll. It's the easiest to document and calculate and provide to the bank in terms of forgiveness. So let's go out as far as we need to on payroll for a covered period and use that for all of our forgiveness. Well, if you think you might qualify for the ERC now because of this new Consolidated Appropriations Act changed that and lets you participate now, and you haven't applied for forgiveness, you may want to think about using more of the non-payroll costs, the rent, the utilities, the mortgage payment, operations costs, things like that can be up to 40% of the PPP forgiveness, leaving more of your payroll to be used for an ERC. So, if you got higher payroll, high average cost of an employee, it may not matter. You may get there anyway, but just something to think about, keep in the back of your head. The IRS is also not going to let you double dip. So if you're taking advantage of paid sick or family leave credits, you're not going to be able to use those same wages for the ERC. And if you have employment positions that qualify for the work opportunity tax credit, which some of you might, those employees, their wages are not eligible for this program as well. So let's talk about how you actually get this money. It's kind of weird. There's not an application. There's not a lot of monitoring at the front end. All the documentation you're going to keep, and I think from everything we've seen, you're going to need to keep it for 4 years. But you're going to need to maintain the documentation that shows you're eligible for this. But you're actually going to get this credit by claiming this amount on your 941, which is your quarterly payroll tax return. Technically, this is kind of in the weeds here. The ERC is really supposed to be the first 6.2% of the employer's share of Social Security tax. However, if your credit exceeds that, you basically keep going until you eat up you can use all of your federal withholdings, federal income tax, Social Security, Medicare, everything. You can eat that up. And then if your credit is so much that it exceeds all of that, you can actually apply for a refund and get that back and not make any federal payroll tax deposits during the month or the quarter. Or, for folks that really are cash strapped and hurting still, there's a form the IRS has now, a Form 7200, that allows you to apply to get an advance. So you estimate how much your ERC credit is going to be, and you can go ahead and get that advanced to you. The thing that's interesting to remember is that the ERC has been here since last spring. You probably couldn't participate because you had the PPP loan. But now with the CAA passed here at the end of the year, that retroactively allows you to participate in the ERC and the PPP. So we're going to go back and look at 2020, right? If you do qualify for the ERC in 2020, you're going to amend your 941s. The IRS is very particular about managing this and monitoring this and calculating this on a quarter by quarter basis. So it's likely that you'll go back and amend your second, third, and fourth quarter 941s and file a 941X. They're not hard to do. But you want to make sure that you're putting that refund and that employee retention credit in the proper quarter, because that's how this is going to be looked at down the road, if it ever is. So just to recap here, how are we getting to this $19,000 per employee? Remember, you got to show in 2020, you got to show a 50% decline in revenue if you're not going to go the government order route. If you do enter the program, you're in for 2 months two quarters before you're out, unless you stay. I mean, if your business has been so impacted that you stay in it, you could be in it, from the second quarter on all the way to the end when it sunsets at June 30, 2021. That's, each company is going to need to really look at their quarterly top line gross revenue. Same definition Jeff referenced earlier. Look at your quarterly revenue and see how far down you are. But for 2021, that decline doesn't have to be but 20%, which is an improvement. And don't forget about my safe harbor there for the immediately preceding quarter. So for all of 2020, the max you can get is $5,000 per employee, right? Because they cap our wages at $10,000 for the whole year. But for 2021, that $10,000 cap is a quarterly cap, so you could get $7,000 per quarter. So that leads us down the road of, for companies that are most impacted, 50% decline in revenue at some point during 2020. I would expect you can now get $5,000 per employee, and if you stay that way, I would think you can get $14,000 per employee in 2021 for a total of $19,000 an employee. And we think that's a pretty beneficial stimulus, provided you qualify. And I hope you'll take a look at that and then give us a call and see if we can help you with it. And that's all I have on the ERC. Ron, you want to share your screen now? Ron's going to cover some. And Ron, don't forget you're on mute. There you go.
I got it.
Ron's going to cover some of the tax changes and a couple of other credits that are out there and some other stimulus components.
Okay. Yeah, I'm going to go through this pretty quickly. I know, like Jeff mentioned at the beginning, that the main part of this webinar was to talk about the PPP loans and this ERC credit. So we did that, and I don't want to take much more of your time, but there were some other tax implications of the CAA, this new stimulus act that came out right at the end of the year. So I'm going to go through those really quickly and still hopefully give time. I know there's a lot of questions out there on the PPP during Jeff's presentation that he's going to try to address at the end. So bear with me. I am going to go through this pretty quickly. The first thing I wanted to touch on was the first item that came out once this pandemic hit was this Families First Coronavirus Response Act. It even came out before the CARES Act, and this is the act that basically said, if somebody has to go home from work because there were some stipulations, they have the virus, a member of their family has the virus, whatever. There were some other things in there that the employer had to pay them for that sick leave, but then they could get those wages back on the payroll tax return. So what they wanted to do is make sure those people were taken care of, but quarantined appropriately. And so that hasn't changed under this. The rules around it haven't changed under the CAA Act, but what they did not extend to make it mandatory for employers now. So as of 12/31, if somebody goes out for the coronavirus, it's no longer mandatory to pay them. But if an employer does still do that, they can still get the credits through March 31st. The rules are all the same. It's just not mandatory for an employer now to pay their employees that time period. Another thing that's big, and I know you've seen it in the news a lot, is the new stimulus, the recovery rebate. Most people have already gotten these, have come through, so I'll go over it pretty quickly. It's $600 per taxpayer, so $1,200 for married filing joint taxpayers, and then another $600 per qualifying child on top of that. The payments do phase out once you reach an income level. And this is the same as the first stimulus. It starts to phase out at $75,000 of adjusted gross income for single taxpayers and $150,000 for married filing joint. A difference this time on this payment is they are fully phased out at $87,000 for single taxpayers when that was $99,000 the first time around. So they basically cut that in half. So you may have there may be people out there that got the stimulus the first time or got a portion of it, but now it's fully phased out this time. And then that number dropped to 174,000 for married filing jointly. But like I said, most people have gotten their payments. There are issues out there. I've talked to clients and other people about they did not get their payment and have something, sometimes they change banks or something like that. So the IRS is still working through that. And hopefully that'll get corrected. But if not, there is an option when you file your 2020 return, you can input, we don't know what it looks like yet, but you will be able to input what you should have gotten and say what you did get. And if you were shorted anyway, you'll be able to get it at that point. So people that aren't think they should get it and didn't get it, there is a way to get that with filing your return. Moving on, and like I said, I'm going quickly, I know, but I definitely want to get to the Q&As for Jeff. But another item that was pretty important in the CAA Act was, President Trump allowed you to not pay Social Security taxes on that last from 9/1 to 12/31 to help employees out. But now they were required at that point to repay those Social Security taxes in the first quarter of 2021. They still have to be repaid. They were not forgiven, but now employees have until December 31st, 2021 to get those deferred Social Security taxes if the employer decided to do that, get those back. And then employers are still liable to collect. So if somebody leaves, you need to make sure to take care of that before they collect their final check, because the employers will be the one that are ultimately liable for this. There are a couple other small items that were kind of in the CAA Act are, for years and years and years, if you have business meals, you're only able to deduct 50% of those meals. Now in 2021, you can do 100% of those. And the reason for that is to help the restaurant industry that has been hurt so bad by the pandemic. So now if you have a business meal for 2021, you can actually deduct the whole thing, as long as it meets the qualified business meals rules. Another issue that was kind of addressed was, at first, banks were going to have to send 1099s for the forgiveness of the PPP loan. They have knocked that out. So no longer you will not get a 1099 for forgiveness of income from the forgiveness of your PPP loans. Now they took that out. And Jeff went through this, how they resolved the tax treatment. So now you are able to take the expenses related to PPP loans and deduct those. So Jeff went over that during his presentation. Just a few more small items that are in there. If you itemize on your tax return, in the past, for 2019 and before, you were limited to only 60% of your cash, of your AGI for cash contributions to qualified charities. So that means if your income was 100,000 and you gave 75,000 to a charity, you could only take 60,000 of that deduction in that year because they were limited. For 2020 and 2021, that's gone. You can actually do the whole amount now, so 100% there. And they've also added something for non-itemizers to give them a break, because they want people to continue to do charity. So, basically in 2018, under the new tax rules, they raised the standard deduction so high to 12,000 for single and 24,000 for married filing jointly. A lot of people don't itemize anymore, so those charitable deductions have kind of gone away. But now they're allowing you for 2020 to take $300 in addition to your standard deduction. So you can get your standard deduction, you can still get up to $300 deducted for qualified charities. And then in 2021, it's $300 per taxpayer. So if you're married filing jointly, you can take $300 per taxpayer for a total of $600. Another item addressed in this was the medical expense deduction for itemized taxpayers. You're only allowed, from 19 and forward, you're only allowed what's above 7.5% of your AGI. that number was set to rise to 10%. You only get what's above 10% of your income as a deduction. That was set to rise to that in 2021. But instead of that, they have permanently set the threshold at 7.5% of AGI as it's been in the past. So that is not going to rise in 2021 as originally scheduled. Few other small items on here was, this has been out there, but they've extended it through 2025. But if an employer pays a student loans, I think they can do somewhere around $5,250 or something that per student, per employee, if they pay their student loan for them, that does not go as gross as income to the student or to the employee who was paid on behalf of. That was set to run out in 2020, but they've extended that to 2025. Another one was this is another one that was extended. If you have more home mortgage debt that gets foreclosed on, you can actually exclude up to $2 million married filing jointly of that debt forgiveness. You do not have to include that as income. That's been here since 2009, I believe, but it was set to run out again at the end of 2020. They've extended that through 2025. And then a new item on this was the flexible spending accounts. Normally those are use or lose. If you don't spend it before the year end, it does not roll over. Now taxpayers can roll unspent funds over to the next year, and that's going to be for the next 2 years. So even in 2021, if there's unused funds, it can roll to 22 to be able to use in that year instead of use or lose now. Then there's plenty more in there, but I wanted to make that quick. And so now I'll give it back to Jeff. I think he can answer some Q&As on the PPP, which I know everybody's most interested in.
Yeah, thanks, Ron. We're out of time on the allotted time. I've been actually, well, Ryan and Ron, while you were talking, I've gone through and answered several, but I think maybe 20. I mean, there's a lot more. There's 49 that we haven't answered yet, and I know you all answered some too. But so we'll cover. I'll just answer some quick questions, and a couple of these I've seen commonly with clients. I just wanted to address a few. When you're comparing quarters, yeah, it has to be, if you're going to look at the fourth quarter of 2020, you've got to compare it to the fourth quarter of 2019. So it's quarter to quarter respective to the time of year, when you're doing the calculation. Also, there's a question in here about new business, and there's different rules for new businesses. And as long as you're in business on February the 15th of 2020, there's a calculation that you will do that will be different than what I just described quarter to quarter if you weren't in business in the 2019 year. So just look at the rules, and they're actually really easy to understand. We're getting a lot of questions about revenue and what's revenue, and I've had some write-offs, and in regard to write-offs, if you've had write-offs, the accurate thing to do is to record those in their proper period. So by quarter, if you weren't paying attention to that before, for purposes of this calculation, you might want to look at your accounting and then do something that's more accurate than maybe what you did before. And that way you can do an accurate comparison of your revenue in one year versus the other, versus if you waited to write off some receivables and didn't put it in the proper period, then it would mess up your calculation of year over year. So I probably have had more questions about AR write-offs than anything else, because I think in general people just don't address those until the end of the year, and it creates quarterly accounting inaccuracies, where for purposes of this, you really want your quarters to be accurate for this 25% test. There's a lot of one thing we didn't really address at all is affiliations, and the affiliation rules still are in place, and those are very clear. And if you're affiliated with another entity, you have to consider the entire entity and not just one part of it. And another question I saw in here multiple times, and I've actually dealt with this, we've got cases where people just don't want to take the whole amount that they would be qualified for different reasons. And I had a client that had that situation, and they ended up, the bank was not set up to do anything different. So you've got to remember, practically speaking, you might want to do something that banks are just not set up to do, so it's not going to be an option. And generally what you're going to find is the bank's going to require that you take the 2.5 or 3.5, if you're a restaurant or hotel, they're going to portion of your payroll, and that's going to be your loan amount. And then if you're not planning on applying for forgiveness for that whole amount, you can pay the other portion of it back and just receive forgiveness for a portion of it. So, but if you're wanting to just apply for part of it, the one situation I had, the bank just could not figure out how to make that happen. And there's a lot of other questions in here. But like we kind of started out saying, for any question that you have in general, it's going to be addressed through Q&As that are on the SBA website, and then other information that SBA has put out there. And then if you can't find the answer, that means it becomes more subjective, and you've got to apply common sense. And one of the really subjective questions that I saw in here was a nonprofit that had received some restricted money, and they're wanting to know if that was going to be held against them if it was for long-term purposes like construction of a building. So that circumstance is not addressed very well, and I would make an argument that something unusual that you really don't have use of to pay employees, and that's really what we're trying to get down to here, is monies available to pay employees where you weren't able to do that before because of the virus. I think you can make an argument that some unusual things like that might be excluded from your calculation, but once again, your bank could interpret that differently, or SBA could interpret it differently, and you just kind of got to go what makes sense, and then see if you can make that work. It ends up being the answer to some of the more subjective things. So I think we'll have to stop now because we're out of time, but we appreciate everybody who's participated in this. And like we provided our contact information. If you have any questions, just let us know directly and we'll help you. And take advantage of all the information that's out there online, and you should be able to fairly easily apply for these funds and take advantage of these credits, and then help your business get through this difficult time. So thanks everybody.